Hello and welcome to the 2025 forecast presentation. I'm Justin Susi and today I'm joined by Lou Harris, Ryan Williams, and Greg Brown. And we're excited to kind of walk you through thoughts for the year and a lot of material to cover, so we'll jump right into it. Important disclosure. And then I'll kick us off with the agenda for today. So domestic equity, we're going to talk about US stocks, international stocks. Ryan's joining us today to chat about commodities, fixed income and bonds. Greg will cover that topic. We'll recap portfolio positioning and then just a couple of announcements and things that we find interesting at the end. And kicking off domestic equity, we're going to talk today about valuations, market concentration, and then really some of the stuff that's in the news and the economy. Starting with valuations, this is really just a look back to 1997 on if stocks are expensive, are they cheap, are they average? So you can see in the middle of this chart here, 18.53 is the average price earnings ratio over this period of time. And you can think of that as just what are you willing to pay for a company based on what they're earning. If you're down here at this below average cost of 14.61, that's kind of a bargain. Stocks are on sale. Anything above the green line means that stocks are just a little bit expensive. So a little bit of backdrop there. Again, you can see from this that charts or stocks spend most of their time and see the average to expensive range. Next chart here just shows out of the S&P 500. I mean, obviously there's close to 500 companies in that index, and this is looking at who's really making the market more expensive. So what you can see here is that the top 10 largest companies, which make up 38.7% of the index, are trading at around a 30 on that number we just looked at. So if you think back to where we were, that 18 or so was kind of the average over time. So you can see here that there's a lot of companies in the market that are trading around average. It's really the top 10 companies that are making things more expensive today. When we look at those top 10 companies, we can see that they do make up a pretty large portion of the overall index. Again, there's that number 38.7%. Graphically here, you can see how that's really the most in recent history, all the way back to 1996. And a lot of that is those companies have grown a lot of new technologies, so not a bad thing in and of itself. But as you'll see on the next chart here, it can make the market more volatile. So this chart is looking at S&P 500 one-year forward volatility. And when you have a lot of concentration like we are right now in this 10th decile, what it means is that volatility or market movement up and down usually picks up and is higher than when the market is not as concentrated. So one of our takeaways is we should see more volatility, more market movements throughout this year. That brings us to inflection points. So taking a look at just market activity going back to 1996, we can see some very key points in time. 2000s, you might remember, is the tech bubble that burst, and we had a pretty poor market environment after that. October of 2007, that was the global financial crisis. 2020 was COVID. I kind of put an X through that. Again, it was sort of an anomaly when it comes to market events. Then we had the bear market of 2022, where tech stocks got hit quite a bit. And then here we are today with another inflection point in the market. If we go back to those valuations, you can see that sometimes these inflections are met by a higher price earnings ratio or a more expensive market. But sometimes, like in 2007, you actually had a market that was trading below average. So it doesn't mean you have to have a correction from these points. It just means that we are looking at the market from a standpoint of not being super cheap. So being careful about where you put your money, where you select your assets. Next on here, and this is a big positive, some of those scary environments we just pointed out on that last chart, like the tech bubble, like the financial crisis, you can see that back then, profitable companies, there were a decent portion of companies that were out there publicly traded that struggled with profitability. And when we look at today, you've got only 7% of large companies are unprofitable, 16% of mid-sized companies are unprofitable. Smaller companies, you've always had a higher percentage of non-profitable companies, but certainly companies today, much healthier balance sheets, much better earnings. So that's a positive compared to some of those other environments. Kind of wrap up on the last couple slides here, but one of the major things that drives stock prices, earnings is spending. So not only spending on the corporate level, but also spending on the household level. So the chart to your left here shows just what some of the big tech companies are spending on artificial intelligence, what they're projected to spend. So we're kind of going from the, 40 to 50 to 60 billion dollars in the early 2020s, all the way up to maybe projections of 200 billion or more. Obviously, the news of last week, DeepSeek spending, what they're purporting to be less money to build a nice AI model that competes with the existing US-based artificial intelligent models. Maybe some of these spending numbers will get revised lower. But key is these companies have cash, they're willing to invest it into AI, and obviously we'll have to see what that payoff is. The second part of that equation is households. So you and me and consumers, how much debt do we have on our balance sheets? So you can see that going all the way back to the 1980s, we're only at 11.3% today as a debt to disposable income percentage. So that just means that the consumer's in pretty good shape for spending and for adding dollars to the economy. Last but not least, just a lot of stuff in the headlines. So some of these are quotes from bank CEOs like Jamie Dimon. Some are from legendary investors like Stan Druckenmiller. But basically, there's a lot of positive news heading into this year about, companies and what they're seeing as far as earnings. Then we've got news like tariffs and maybe reduction in government spending through DOGE. Again, just more of a reminder here that none of these headlines are going to drive our investment process. So we have a disciplined process. We buy a lot of outside research and a lot of data, put that together in models and indicators where we're tracking, the health of the economy, the health of the stock market. So from what we're seeing so far, the markets are still in a bullish trend. The markets are still generally moving higher in the intermediate term, and we're seeing our indicators stay fully invested and basically in a risk-on posture. So we're not going to change that based on what CNBC is saying today or what a headline might say as far as tariffs being good or bad or reducing government spending. Obviously, those things will affect the markets in the short term, but a lot of noise will be back and forth on those items. With that, I will kick it over to Lou.
All right, thanks, Justin. Yeah, so just talk a little bit about international markets, how we've been positioned, and just sort of some opportunities and some threats that we're seeing right now. So traditionally, we've been fairly underweight in international investments in some of our models, and so a lot of that's just due to the strength of the U.S. markets. So on the next slide, what we're going to see here is just how we rank these different asset classes. And this is probably a familiar slide that you've seen. Normally, international equities is holding that number 2 spot, but a few weeks or maybe a few months ago, that was overtaken by commodities. So a lot of strength in commodities taking over the number 2 spot, and some weakness in international equities has pushed that down to number 3. But just something that we're always looking at in our top-down approach of sort of giving a market a physical every week when we look at the different strength of the asset classes, where they are. Now, these don't change too often, but we just have to keep our eye on the ball of where they lie and where there's momentum and what direction it's headed in. But overall, big picture, we've got 27 of the 37 central banks that are lowering interest rates. So even a few years ago, most of these were increasing interest rates, just as we were here in the U.S. And so since now we're sort of at a net lowering rate, that should act as a tailwind for international markets. Now, a lot of that depends on inflation and, of course, the news with the tariffs and potentially igniting inflation is always a risk out there. But overall, we are more comfortable in this position. The market's more comfortable globally and domestically with lower interest rates. Now, part of that is some of the big central bank behemoths like the U.S. or the European Central Bank and the Bank of England keeping rates at a reasonable level. And so a lot of that depends on where their inflation numbers lie, which on the next chart, we're just going to see just over the past 10 years or so where inflation has been for the Bank of England. Right now, it's at around 2%, but it's coming off this peak just like we are here in the U.S. And so we have to keep that number right around that level in order for the Federal Reserve to stay on that net negative or that net lowering of interest rates overall. That could be an opportunity for international markets to pick up the pace a little bit, perhaps get some more strength and maybe even overtake the commodities sector. So talking about tariffs on the next chart, I like this chart because it kind of gives us some perspective all the way back into 1910 of tariffs. And what you can see is that this is from what was proposed and enacted over this past weekend, but then given a little bit of a pause here recently with Mexico and Canada. But just in relation to historical tariffs, this is sort of off the charts, if you will. So we're about 25%, which compared to 1930 in the Smoot-Hawley Act, that was around 20%. And so we'll see if these actually stick. I think a lot of these numbers came in pretty hot and heavy, and they may be reduced over time, but that's kind of what we're going through right now with those two countries specifically. International markets we're kind of becoming more intertwined. And what I mean by that is really half of the revenues generated from the Magnificent Seven, which is your Googles, your Amazons, your Facebooks, half of their revenue is generated internationally. So that's kind of a threat if these tariffs are going to stay in place and how long they're going to stay in place, if so, because that would have an impact on the revenues for those large companies. When you consider the other 493 companies in the S&P 500, their revenue from international markets is about 25% or a quarter. So really, when we talk about international markets, we have, by investing in some of these Magnificent Seven companies, we are getting exposure to international markets as well. So if we do get that tailwind of central banks keeping rates low and costs not, inflation not coming back, we could see that as a pretty good opportunity as well. So I always like to talk about China a little bit too, just because it's always in the news what's going on with China. It's a big part of the emerging market space. And so what you can see here, we've got about 30 years of data that we're looking at between the three different graphs. But from about the 2000 mark to 2010, when the U.S. was going through its lost decade, where really the S&P was at the same level at 2000 and 2010, China was sort of taking off at that point. And so you can see those increases there in productivity and growth in GDP. But then ever since really 2008, 2009, they started to tail off, and we've just seen sort of a decline in GDP with China. And that really got exacerbated during COVID when they kept the country locked down for so long. And we talked about this a little bit last year, how China really hasn't come back to market quite yet, and they're kind of stuck there as well. Now, there's been some good news that's come out about their AI model and DeepSeek, but I think that they're still just in a struggle of getting plugged back in, because in the meantime, a lot of the emerging markets outside of China have picked up the slack where China was doing most of that work. So we'll continue to see if that continues on the decline, or if at some point it does find a bottom and recoups. But on the next slide, we can just see what that's actually done to their earnings. And so the line that's on the top is showing China's GDP, which has continued to grow. There was a slight speed bump during 2020 and COVID, but really that hasn't been the best time for their stocks. And so a lot of their earnings are just kind of maintaining a flat pace and not quite growing with GDP. So that's kind of kind of a problem right there. So we'll see if eventually when they do come back on the market, if that lifts the entire emerging market space, or if they're just going to kind of continue to go sideways for the time being. So overall, we're still in a just kind of an underweight position internationally, and a lot of strength in the U.S. market. So until that tails off, we'll continue to keep that allocation going forward. I'll pass it on to Greg for some fixed income updates.
Yeah, thank you, Lou. And a few big picture topics we can discuss on fixed income. Want to look at performance after hiking cycles have completed. I want to talk about the importance of yield on total return for fixed income, the importance of real yields, so yields above inflation, and then talk on what we've seen in rates. We've seen a surprise uptick in longer term rates, and really including last week, we've just seen a dampening of expected Fed rate cuts over 2025 and 2026. So I like this first slide. It discusses fixed income outperformance once the Fed rate hike cycle is complete. So this looks at various areas of fixed income and how it's performed versus cash. Specifically, this chart looks at 24 months after the Fed has completed hiking rates, which for our vantage point, it was July of 23 was the last rate hike from there. But historically, and this goes back over the last 5 Fed rate hike cycles, historically, really almost a 2x outperformance by investing in fixed income over cash. So again, once you have that visibility into the top of the Fed hike cycle, it really is a lot, kind of safer to get in the water of fixed income, and significantly so. And that's really what we've been pushing now that we're more in a rate cut environment versus a rate hike environment. And this chart, it's a little bit of an overstatement of the obvious, but it just highlights the importance of yield in terms of the overall total return that you get from bonds. So when you look at this, the circle, the yellow circle, designates a total return in these various fixed income asset classes: high yield, investment grade, municipal bonds. And then the dark blue represents how much of that return you got from coupons. And then the light blue is how much you got in price return. And really, across the board, 90+% of performance is bonds. It just comes back to the starting yield that you get. And why that's important is over the last, the yields that we have right now are near the highest mark that we've seen in the last 20 years. So again, for a lot of our models, we're a little heavier on fixed income. We like the return proposition you can get with the higher yields that we're at right now. And this chart looks at the real yield that you get over the last 25 years for a 10-year Treasury bond. And just to be clear on real yield, it's basically, again, the yield or the income that you get from a bond minus what kind of gets eaten up by inflation. So if you have a bond that's yielding 5%, inflation is 2%, your real yield is 3%. And the circle over there on the right of the chart shows exactly where we are right now, where the yield is about 4.6%, inflation closer to 2.3. So the real yield is, and it's listed below, 2.23%. And again, that's the yield that you can get, grow your purchasing power over inflation. And historically, again, over the last 25, 26 years, that real yield is 1.35. So not quite a doubling, but certainly a good environment to be having some fixed income in the portfolio and give yourself some protection. And it's important to note that this real yield is just for a 10-year Treasury, which is risk-free. If you go up the risk spectrum even a little bit to corporate bonds, mortgage-backed bonds, or preferred stocks, that real yield is even higher. And then we thought this slide was interesting. It just every now and then the bond market will throw you a little bit of a curveball, and we have seen that over the last 4 or 5 months. So this looks at the 2-year and 10-year Treasury bonds and what the rates have been doing. It's kind of over the last year, but where it gets interesting is you see kind of the bottom where they bottom out in September. From September, what happened is the Fed cut rates 4 times, so 100 basis points or 1%. And most people were expecting interest rates to go down, and by that I mean the longer term bonds. But we've seen exactly the opposite. So the Fed is cutting rates, and yet these longer term bonds have gone up almost 100% inversely. So they've gone up about 1% while the Fed has cut 1%. And it's important to make the distinction. What the Fed controls is ultra short term, so they control overnight lending from banks, and that's really all that they control. These longer term bonds, 2-year, 10-year, are more driven by the economy. So when we see a strong jobs report, when we see a strong GDP report, if inflation stays high, that tends to have an increase in longer term interest rates. And unfortunately for borrowing, if you're getting a car loan, if you're getting a mortgage, those are more tied to the 10-year rate. So even though the Fed has been cutting, you haven't gotten much of a reprieve in terms of what you're paying for auto loans or car loans, or I'm sorry, mortgages. And all this flows through to what has happened over the last 3 or 4 months in terms of rate cut expectations out of the Fed. And again, they started cutting in September. They cut 1% last year. They cut 50 basis points in September, once again in November, and once again in December. And since then, the kind of yellow or orangish bottom of this chart is what what the Fed's expected rate cut path was going to be for 25 and 26. So again, meaningful cuts over the next 2 years. But there's been a pretty meaningful reset in that. So kind of the upper reddish color there is where expectations are right now. Significantly higher, which means not as many rate cuts. Really, the market is expecting about 1 rate cut for 2025 and maybe 1 or 2 for 2026. So again, a pretty big reset in terms of expectations for Fed rate cuts on there. And it's fluid. The Fed came out, they spoke last week, and they were saying, we're just not in a hurry to cut rates. So they're very data dependent. This could change over the next few months, but from our standpoint, over this year and into next year, there's going to be a lot of kind of nothing dones with these Fed decisions. And with that, I'll kind of pass it over for some portfolio opportunities and thoughts there.
Thanks, Greg. Diving into the commodities, I like to start with the US dollar. There's a lot of talk about, the dollar's stronger, the dollar's weaker. And I just wanted to start with a framework. A lot of times when the dollar is mentioned, it's actually the dollar index. And the dollar index is comprised of a basket of currencies that are always going to be compared to the dollar itself. So right now, the euro is the largest component of the dollar index, roughly 58%. And they keep the index pretty square. So these percentages don't fluctuate very much. So in a rising interest rate environment will also come into play, as well as a strong dollar. So here on this slide, we can see that if the dollar is rising, it has a different impact on different commodities. So the falling dollar environment are the red bars, and a rising dollar environment are the green bars. So we can see that, copper, if the dollar is falling, it tends to perform pretty well, versus if the dollar is rising, performance, it's a big headwind for some of these metals. Now, energy is the only major commodity that tends to buck the trend. It definitely outperforms in a rising dollar environment, but it also, over the last 34 years, this data is also up. Now, we are also going to talk about piggyback on what Greg just mentioned. We're going to talk about yields here coming up. But the next slide is a chart of the dollar. And we can see since the great financial crisis going back about 20 years, we can see the dollar has been trending higher. And by definition, that is just putting in higher highs and higher lows. It actually peaked late last year and has pulled back and has been consolidating. So does the dollar have enough strength where it could run higher back into that recent high? Or maybe it stalls out here. So we're watching this very closely because this will impact not only commodities, but will also have an impact on foreign markets as well. So the next chart is diving into correlations. We are lucky here in the United States because most commodities are dollar denominated, and commodities don't pay a yield, so they have a headwind when it comes to higher yields. So the left shaded area is a period where the 10-year yield is rising. So it went up for about a year, thereabouts. And then it found an equilibrium and went sideways for a period. And you can see that gold, silver, and copper all declined during that period. Now, what's interesting is correlations, they do break. They're not always one for one. And in the left shaded area, that is a negative correlation. In the right shaded area, we can see that starting midsummer of last year, the 10-year yield was going higher, as well as gold and silver, but copper definitely had that headwind. It was not able to make any advances. Gold quietly outperformed the S&P 500 last year. So, commodities are always one of those groups you have to keep an eye on. They're a little bit harder to play than definitely equities, but it's key to keep an eye on them. We do have exposure to gold and silver. Gold made a new high last month, and silver actually outperformed gold. So, in the next area, the next largest area that we focus on is the energy markets. And we can see helping inflation stay in line is that oil has been relatively well behaved. And what I mean by that is it's been pretty much sideways. It's hanging out in this 65 to 85 range. And anytime oil spikes, that's where it can lead a disruption to, be a big headwind for global economies. We will see oil spike based on geopolitical events, or maybe economic growth is surprised higher. So it's definitely something to keep an eye on if it breaks above 80. On the other hand, the next chart is what we look at in natural gas. The big chart here is it kind of looks like an EKG. We have periods of big impulses. Right now, natural gas is kind of flirting in the $3 range. Just as it kind of is mean reversion type of trade. It will spike up into the teens and then find its way back down to, say $4, $3 to $4. So we've got to keep an eye on that. If it breaks above here, based on some geopolitical and weather events here in the United States, it could be a very good trade. We play commodities, especially oil and natural gas, right now through some of the, we look at the pipelines that distribute and move these products. And then if these commodities start to move, we can look at the producers. So gold and silver, we can look at mining companies. oil and natural gas, we would look at some of the large refining companies, exploration, and then the well services companies.
Thank you, Ryan. I will do a little magic trick and jump back up. There we go. Portfolio positioning. So again, just a recap of what you've heard from Ryan and Lou, but on the equities and the stock side, number one, just stay diversified. So we reviewed how the top 10 companies, although they've been great, they've performed really well, they are expensive, there's some risks there. So we're keeping a close eye on those. We want to be diversified across the board and make sure we own the companies that are more fairly priced as well. Still like income producing equities. So if we get a lot up and down volatility, at least with those, we get paid every quarter some dividends, or if it's an exchange traded fund, we might get paid some on a monthly basis or quarterly basis. So we like the income that's coming in on that equity side. In some of our models, we're staying just a tad underweight equities. Again, we want to have just a little bit of dry powder if prices get cheaper so that we can put that money to work. You heard from Greg on the fixed income, the bond side. Again, combination of opportunistic funds, high quality funds. We don't have a lot of government bond exposure, just kind of staying out of that picture. We're getting kind of better yields elsewhere without the headline risk. And like Greg mentioned too, we're pretty full on those, about where we want to be, find those to be a good risk reward. Ryan, covering the energy area, mentioned some of our energy likes and some of what we like in the metals. Again, energy side, we've got some utilities, we've got some oil and gas pipelines, some individual companies as well in that area, and then gold and silver on the metal side. Certainly probably other opportunities coming in that alternatives area when you look at AI and the materials needed, self-driving cars, automation materials needed. So it's an area we're keeping an eye on. And the international side, kind of skipped over that, but in that top section, as Lou mentioned, stay underweight there. Look for opportunity. It is dirt cheap. I mean, it's really cheap in the international markets, but as you've heard us say for probably 5-6 years in a row now, no one still cares. So we're waiting to see the prices come off the bottom there and see if investors get excited about it. Last but not least, the cash. We are moving that into more bond positioning. The chart Greg showed on how bonds typically outperform cash at the end of a rate hike cycle. I think our positioning would still be that the Fed is done hiking rates. I mean, obviously anything can happen, but we don't necessarily see the tariffs in and of themselves becoming inflationary. Certainly other things could happen. But typically with tariffs, you're just switching goods and services that you're actually paying for. What really drives inflation is excess money supply. So again, just our opinion at this point that we would need more than just tariffs for inflation to get back on its horse. I'll kind of another magic trick, get us back to the just interesting section. A couple of things here. So one piece of change in the law was the repeal of the windfall elimination provision and the government pension offset. So these were changes to Social Security that were in the Fairness Act, and it impacts government workers, teachers, people that were in civil service, law enforcement, fire. And what this did was basically there was always an offset if you had Social Security and pension benefits, and typically you did not receive a full Social Security payment, there'd be some form of reduction. So the key outcomes of this is that this is potentially a fairer benefit calculation and potentially higher benefits for folks that are affected. So the bad news is that Social Security is still trying to figure it out. We will certainly be talking to you about this in our review meetings and making sure that we're looking to see if you could be affected by this. Chances are it's all going to be backdated to January 1st, 2024. So don't want anyone to feel like they have to rush out and do something about this. Social Security typically pays backward looking, so I would assume that's the same thing here. more information, you can jump on Social Security's website, but again, they're still trying to figure out how to implement, and some of this might just be done internally with them. I don't know that they would want, 20, 30, 40 million people calling them all at the same time. So hopefully something they can just figure out internally. And last but not least, a new addition to our team, Scott Jensen. So some of you may or may not know, but I've worked with Scott kind of personally and professionally for almost 20 years. And he's decided to join our team and kind of help us in the estate and tax planning area, consulting. Again, we're not preparing estate plans. We're not doing tax returns. I know some were hoping that was the case, but just not something I want to step on, in an area I want to get into. But what we will be doing is making sure that your big picture financial plan integrates with the professionals you're working with on the tax and estate side. Just make us more efficient from a tax planning standpoint, as well as passing your assets on to the next generation. So feel free to talk to Lou, myself, or Greg about this, and we'll again be bringing this up as you have your review meetings throughout the year to see what kind of benefits we can bring to you through this edition of Scott. And also feel free to reach out to him directly. So he'd love to hear from you. All right, I'll bring everyone back on if they're still here. We went a little long today, so apologize for the length of it, but a lot going on, a lot of news. I want to thank you for tuning in, and thank the team that I've got here. As you can see, engaged and interested in what's happening in the markets. And I guess last maybe comment is don't get too stressed by headlines. Let's follow process. Let's follow earnings. Let's follow what's happening in the economy and the markets. Because it is likely to be a more volatile year, and just know that we have your back and we're here watching it each and every day. So thank you for joining us, and reach out if we can help in any way.
Thank you.